Hi, everybody. This is Jose Luiz Morales with the Morales Real Estate Group. Welcome back to the Jose Luiz Morales Show. This is episode number 24. Today, we've got a very, very special guest, one of my favorite people in the whole wide world because he's saving me a lot of money in terms of taxes, Mr. Yonah Weiss, correct?
That's right. Yeah, perfect.
So he works for Madison Specs. It's a cost segregation company. For those of you that don't know what that is, it's one of the largest benefits as it relates to real estate investing. For a long time, I've been investing in real estate. I didn't know about this. So I was involved in a very large purchase and reached out to Yonah, and he filled me in. And now we're working together and saving a lot of money in taxes. So welcome to the show, Yonah. How are you?
Thank you so much, Jose. It's really my pleasure. I appreciate you having me on the show and happy to, share my knowledge with everyone, all your listeners and everyone that's going to tune in today, because I guarantee you're going to walk out of this show, especially if you own commercial real estate, investment properties, you're going to walk out of this show like with your mind blown.
Absolutely.
Guaranteed.
That's how I feel. And like I said, I've been working with investors, and I mean, this is the first time that I've heard of it. Now I have personally done this. I'm benefiting from it. So I know that it's something good for our consumers. So there's a lot of people out there that invest in real estate. And before, I was like a cash flow type of guy. Like I would strictly buy real estate for the cash flow. But the part that I didn't understand is that a huge benefit to buying real estate is the depreciation aspect of it. So what is depreciation? How is it calculated? And how does cost segregation fit in the depreciation aspect of it?
Yeah, absolutely. So depreciation sounds like a negative thing, right? Mm-hmm. But it's actually not. In tax terminology, depreciation is actually a borrowed term. Okay, because the concept of something going down in value doesn't actually really apply to real estate, because real estate is actually going up in value. It's appreciating. Nevertheless, the IRS gives you a tax deduction based on the concept that property or that things go down in value as time goes on. So it's based on that concept. But when you buy a property, the day that you buy that, the purchase price that you spend on that determines what your depreciation basis is. I mean, the amount that you can actually deduct. And the IRS literally allows you to write off the entire value of your property. So you just buy a building for $1 million, you're allowed to write the entire amount off, but not all at once, right? You can only write that off on the schedule that the IRS allows, which for commercial properties is 39 years. And for residential properties, which includes multifamily, even though it's commercial, it's considered residential, is 27 and a half years. So that means you can take that $1 million and write off a deduction from your income tax every single year, $30,000 every single year for 27 and a half years. That's what depreciation is, okay? And it's great. You don't have to do anything, and your property is going up in value, is cash flowing, and nevertheless, you get to just deduct from your income and pay less taxes based on depreciation.
So in other words, to simplify it for the listener, let's say you make $100,000, your property makes $100,000 in net income. Right. That would mean you'd have to pay taxes on $100,000. Now, let's say you have $100,000 of depreciation. The $100,000 literally wipes out the $100,000 that you make. So in essence, it's a break even.
Yeah.
In other words, so essentially, you're breaking even on paper, but in reality, you're making $100,000 because of the regular depreciation. Now, the way that Yonah explained it, if it's $1 million, your purchase price, you divide that by 39 and a half years. 39
for commercial.
39. And that's the amount of depreciation that you get to take based on the IRS schedule. Now, with cost segregation, it's completely different. And Yonah is a cost segregation specialist, and that's oh yeah, I lost you. So Yonah is a cost segregation specialist. So how does cost segregation works as it relates to depreciation?
Right. So cost segregation is just like a friend of mine likes to explain. It's like depreciation on steroids. Okay. Now the name is really weird, but basically what it means is we are dividing up the assets in the building that actually depreciate at a faster rate. And like I said, the building depreciates, meaning you can take that deduction over a 39 or 27 year basis. I'm just going to use 27 and a half just because we're talking residential right now, just not to confuse and keep saying 27, 39. 27 and a half years is a long time to wait. Mm-hmm. And the IRS says that really things in the building, you should be depreciating each asset according to what its real life is. And they gave lives, depreciation lives to personal property, which is a 5-year life, which means carpeting, appliances, furniture, fixtures, your cabinets, all of that stuff, anything that's not considered part of the structure of the building, even though carpeting, you would think it's like attached. No, it's considered 5-year property. That means you can write off that value in 5 years. But you can't do that unless you have an engineer, according to the IRS guidelines, in cost segregation. And check it out. Anyone wants to Google this, the Cost Segregation Audit Techniques Guide. Okay, that is the booklet you can find on the IRS website, which goes into details of how to actually do this and implement this. And one of the principles is you have to have someone who has expertise and knowledge in the actual, doing of this, in the implementation of this, and that's an engineer who is specially trained to see, there's this X amount of light fixtures, there's X amount of square footage of carpeting. All of that comes back, prepares a report which details the cost. Okay, so now this is cost. That means the value, right? You have 100,000 square foot of carpeting in your building, in your 100,000 square. You have each one square foot of carpeting is, X dollars. That now translates into a value, and you can now deduct that from your taxes at a faster rate, meaning instead of lumping everything together over 27 years and taking $30,000 each year on that million, you can now front load a huge amount of that. We're talking 20%, maybe 30% into the first 5 years. Mm-hmm. And now you're getting, double or triple the amount of depreciation in those first 5 years than you would have otherwise.
Yeah. So who does this benefit? Like, who is this for? Like, let's say that you're able to segregate a certain part of that building and depreciate a lot faster than you normally would. Who would it benefit?
So it benefits, anyone who's going to be paying taxes. Now, it benefits more than anyone else, real estate professionals. Mm-hmm. Okay, real estate professionals is actually a special status, a box that you can check on your tax return, mm-hmm. which says that it's crazy. It's like sprinkling magic fairy dust, on your taxes. It's usually depreciation is considered passive loss. Okay. Now, passive losses can, generally speaking, only be used to offset passive income. So like you described before, Jose, if you have $100,000 of income net produced from your property and you have $100,000 depreciation, that offsets that. You pay zero income tax on that. But federal, correct. Well, it also can apply to state as well, which is great. Now, but not property taxes, right? We're not talking property taxes today. We're talking only income tax. Now, what happens if you have more depreciation than you have income? Mm-hmm. Okay, so if you are a regular W-2 worker and you happen to have a side hustle and you have a job and you have some properties as well, or you invest in real estate, you can only take the depreciation to offset the income from the property. Okay, if you have less than $150,000 of adjusted gross income, there is still an amount that you can use to offset your other income as well. Without getting too bogged down in the details, I just want to say one more thing on this, which is that a real estate professional, okay, this definition allows you to take the depreciation and now use that to offset not only the income from the property, but any income you have whatsoever. Okay, so you're a real estate broker and you own properties as well, and you now have a $500,000 commissions that you're making. Besides for the income from your properties, you can now use depreciation to offset that income as well, which means reducing your taxable liability way, 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 way down.
Let me ask you, in order to be a real estate professional, do you have to have a license, or is there a requirement on it, just how many hours you spend in real estate activities?
Yeah, so you don't need a license. It is simply an hourly qualification. So it gets better though, because you don't even have to have that qualification. Just one of a spouse, right? If you or your spouse qualifies, which means one of the couple can be a real estate professional, right? And your wife or your husband can, be a high income earner. Mm-hmm. Can be a doctor, a lawyer, it doesn't matter what, making tons of money. And now you're finally jointly, you can use depreciation to now offset all of your income altogether. So this is a great strategy. And again, just to clarify, it's an hourly qualification. There's two qualifications basically. Number one is that you need to be spending more than 50% of your time involved in real estate, which is brokering, managing, right, constructing, doing actually involvement in the properties. And the second qualification is that has to be a minimum of 750 hours a year, okay, which is not a lot. If you divide that up, it's about 16 hours a week. It's not a lot of time. It just means that you can't just retire and not do anything and still get that status.
So for somebody like me, or somebody that is pretty heavily involved in real estate, I mean, this is perfect. So what Yonah is saying essentially is that, let's say that I have a property that makes $100,000, but I'm able, let's say, to depreciate $1 million on that property for that year. Mm-hmm. That is a paper loss of $900,000 on paper because of the depreciation on that property. Then I get to take, let's say I make $500,000 in real estate income. I get to offset that real estate income on that depreciation. So essentially it's a loss on paper, and I can use it as long as I qualify for the real estate professional, the requirements that Yonah just said, and you can offset your actual regular traditional income based on that. Now, as it relates to the example that I said is $1 million.
Right.
I mean, is there something? What is bonus depreciation? Explain that concept to people and how that can actually benefit them as well too.
Right. So bonus depreciation is a new law that came about in the tax reform a couple of years ago, mm-hmm. Which is not something different than cost-segregation. What bonus depreciation is called 100% bonus depreciation. It's an election, which means it allows you to choose to take all of that extra depreciation that we're front loading into the 5-year property, okay, that we're reallocating to stuff that depreciates over 5 years and stuff that depreciates over 15 years, which is like land improvements, landscaping, pavement, all the stuff outside the building has a value to it. All of that normally with cost segregation, we're front loading that, we're depreciating that over 5 years and 15-year period, okay? But bonus depreciation means you can elect to take the entire amount in year number 1. Okay, so if you have a $1 million property, just go to our example, and 20% of that is being cost segregated, meaning is being front loaded into those 5 and 15-year period. So you would normally take extra besides your regular depreciation. Okay, you're taking extra $200,000 over that 5-year period of deductions. Okay, it's not free money. It's not like you're getting a refund from this, but it is deductions. Now, bonus depreciation allows you to take that entire $200,000 in year number 1. And so that's really where the biggest benefit is going to be.
Especially for people that make a decent amount of money, this is a huge benefit to those people, just because if you're making a decent amount of money, that means you're paying a lot in taxes.
Right.
So aside from the potential cash flow that the property provides, now with the bonus depreciation, you can take a big loss on paper because of the depreciation, which offsets your regular income, which means now you pay less in taxes, which means now you have more money to invest back into real estate.
Exactly.
You can continue doing it over and over and over again. And then it gets to the point where there's certain people that don't pay any taxes.
That's right? The way to do it, right? I mean, it's funny, there was an article like last year, I remember Jared Kushner, right, doesn't pay federal income tax, hasn't paid federal income tax for the last, 10 years, right? And he has a net worth of $300 million. Like, how is that possible? So like New York Times, they write this, he's doing some tax evasion strategies and stuff. He's doing cost segregation, okay? I know for a fact because his family is a client of Madison Specs. These people who are real estate investors know the rules, okay? And you have to learn the rules. But these are the rules that the IRS gives you. But they're not going to go out and tell you that, hey, you can take these extra deductions. You have to actually be proactive to learn how to play the game. And that's really how real estate people make the most money. Not just that they're making tons of money, but that it's completely, almost in many cases, tax-free money.
So there's a lot of times where I read or I hear about people like getting into trouble doing tax evasion, that sort of thing. Essentially, the IRS has a rule book. And if you learn that rule book, and they give certain benefits to people that follow that rule book, if you learn the benefits that they give, because there are benefits like cost segregation that they give, and they encourage certain behaviors. So if you do certain activities, they encourage that, and they'll give you certain tax breaks for doing that. So let's talk about Donald Trump. Does Donald Trump do cost segregation?
100%, absolutely.
Okay. Now, that's probably one of the reasons why he doesn't want to show his income taxes, and a lot of time he doesn't want to do that. How would cost segregation benefit in a hotel user, and how does it benefit different asset classes? Like, for example, like how does it benefit multifamily? How does it benefit retail, commercial? How does it benefit hotels? How does it benefit different types of real estate?
So it's going to be beneficial to anyone that is investing in commercial real estate. And there are, like I mentioned before, since each property is different and the engineer is coming to identify in each property how much personal property, quote unquote, personal property is in there, there are certain, like you mentioned, certain types of assets that will have more of those than others. And some of them are more on the personal property, that 5-year asset class, and some of them are on the land improvements, the 15-year asset class, which also gets accelerated and is also eligible for bonus depreciation. So generally speaking, multifamily properties will produce between 20 and 30% of reallocation, which means we're taking the purchase price. We have to subtract a certain amount for land, because land does not depreciate. So whatever that is, whether it's 10%, 15, 20%, there's a certain amount doesn't depreciate. But whatever is left over, 20 to 30% of that can be reallocated. Hotels are usually also around that amount, sometimes a little more, because there's a lot of furniture. Okay, we think about all of the furniture that's in hotels, all the fixtures, the curtains, every single room, all those stuff is eligible for 5-year treatment. Retail, a lot of times we'll have, especially shopping malls and things like that, have a lot as well. But also benefits because they're going to have a lot more of the land improvements, the huge parking lots. Think about that. All of that concrete, all of the the light posts in the shopping centers, all of the signage, all of that is 15-year property, which means you can depreciate that faster. There are a couple types of properties that have a few types that have significant amount more than others, and there are some that have much, much less. So think about like a warehouse. You buy the property, but there's not much there. Okay, you're not, maybe there's some shelving, maybe there's some lighting, certain types of plumbing, but it's very little, usually around 5 to 10% of that reallocation. Whereas assisted living or senior living, where you're having a lot of equipment in every room, a lot of special beds, special equipment, all of that has value to it and a lot of value. So assisted living could be upwards of 30, 40% of that 5-year property. Mobile home parks, okay, and golf courses are two specific asset classes that have more than any other type because they are almost entirely land improvements. Now you think about it, you just own the land, right? You own the mobile home park. You don't even own any homes. Let's say they're all tenant-owned homes. You actually own the land, but you own what's on the land, the concrete pads that are under each home, all of the roads that are connecting those homes, the landscaping that's involved there, the fencing, all of that, that's really what you own. And all of that is 15-year land improvement, which means you can literally take on mobile home parks, listen to this, between 50 and 80% of reallocation to land improvements, which means that all that is eligible for bonus depreciation.
So we have a question from a good friend, Paul Shao. He's asking, does cost segregation deduction have to be added back on the sale of the property as well too?
Yeah, so when you sell a property, you have depreciation recapture tax, which means that you're now going to be taxed on the amount of depreciation that you took during the ownership of your property. Now, the main benefit of cost segregation is the time value of money, okay? Mm-hmm. If you are, it's your, first of all, this is something that Tom Wheelwright, speaks about in his book, Tax-Free Wealth. It's your money. We have to get out of our head, right? Yeah, we have to get out of our head that taxes are an obligation. Taxes, it's your money. It's not the government's money. So if there are ways that you can keep your money for longer, okay, that's going to be beneficial. But the time value of money is that $1 today is worth more than $1 5 years from now. Now, your personal, your taxes, your tax rate may be if you're a high earner, maybe upwards of 39, 40%. The depreciation recapture tax is capped at 25%, which means that the spread between the 37% or whatever and the 25% between now and then is also going to be beneficial to take that depreciation deduction now and then have to pay tax on it at sale, as opposed to paying taxes now on your own money. You get to keep your money. And like Jose said before, you can take those deductions now, use your own money to reinvest, and you're making money with your own money.
Yeah.
Yeah, great question, Paul.
Not only that, Paul, but what I've read in books is that a lot of the strategies that seasoned investors use is they just keep exchanging their properties. So they continue to if I sell and I do a 1031 exchange, I don't get taxed on the money now, so I'm deferring taxes. So let's say that I take depreciation on this property and I take the bonus depreciation now. If I sell it 10 years from now, I exchange it. I don't pay taxes. I do it again in another 10 years. I do it again. I do it again. Once I die, the tax, I get an adjustment on the basis. The basis goes up to market value most of the time. And if my portfolio is worth less than the inheritance tax, then I just avoided the taxes throughout my entire lifetime. So there's different tax strategies to essentially answer the question about, does it happen when you sell? Now, if you're planning on selling, then obviously it's a different situation.
Correct.
I read this book, Loopholes of Real Estate Investing, and this is where I found out about cost segregation. And to someone like me, I mean, it benefits me tremendously to do something like this, because you save a lot of money. You can offset a lot of your real estate income by doing something like this. So I wanted to ask you this, because had I known about cost segregation, I probably would have bought bigger buildings sooner. Mm-hmm. Is there a minimum dollar amount that it doesn't make sense to do cost segregation? And is it only for big commercial properties?
That's a great question. It actually used to be much more, and that probably the reason why it's so little known is because it used to be done only by the big accounting firms that they have engineers in-house that did it, and the cost to do it was $30,000, $40,000, $50,000 to do this. Nowadays, the cost has gone down significantly because there are a number of national firms like Madison Specs out there. So the cost is going to be significantly less. Therefore, it's going to open it up to a lot more properties. My rule of thumb, generally speaking, is any property purchased for over $1 million is tremendous. It's just a no-brainer. It's tremendous benefit there. Anything less than $500,000, I wouldn't push it, and I would say it's probably not going to be worth it. There's still going to be benefit there, but it's going to be marginal, and it's not, probably not going to be as worth it. Okay, the cost to do such a thing on multifamily properties, for example, is anywhere between $4,000 and $6,000. Could be a little more for much larger properties. That cost, okay, if you're getting $100,000 of tax benefit, so $5,000 is marginal. It's insignificant, right? However, if you're only getting $20,000 of tax benefit, and you're paying $5,000, it doesn't make as much sense. Okay, So that's generally my rule of thumb. What I will say is that if you have any property purchased, even retroactively, you can do this. In the past, it doesn't have to be in the year that you bought it. You can do it retroactively. I would reach out to get a free estimate, because we provide run the numbers so you can actually see, hey, what would this look like if I'm doing, I'm not doing cost segregation, just my straight line depreciation. What's my tax benefit versus if I do, the cost segregation, the depreciation on steroids, right? And I'm getting those tax benefits up front. What does that look like? And that's for free. It's really educational. I highly recommend it.
So I'll give the viewers a really quick, real life example. So let's say somebody's purchasing a $4 million property. And let's say that property generates $100,000 in positive cash flow after all expenses. And let's say that over the standard, you depreciate that over 39 years. Let's say it's $100,000 per year in depreciation. $100,000 in profit, $100,000 in depreciation washes it off. Now, with a cost segregation study on a $4 million property, you can depreciate about 20, maybe 20%, 25%, maybe.
It's conservative, yeah.
So let's say $1 million you can depreciate over 5, 10 to 15 years, accelerate it versus the $100,000 per year. Now, with the bonus depreciation, instead of depreciating over 5, 10 years, you can take all of that on the first year, which means you get to depreciate $1 million the first year. Now, if you make 500,000, that wipes out that entire $500,000 profit that you made, and now essentially you pay $0 in federal taxes for the next $1 million because that bonus depreciation. What it means is that you have all this money left over that you saved on taxes, and now you can do it all over again.
Right.
Now you have all that money you saved on taxes. Now you go out, you buy another property, a big property, you do the cost segregation study again, do the bonus depreciation, and do it. How long does the bonus depreciation last? Like what is the schedule? Because I know that it just went through in 2017. What is the schedule for the next 5 to 10 years on bonus depreciation?
So they set it up that 100% bonus depreciation is going to last until 2023. At that point, it's going to start to phase out. That you can only take 80% bonus depreciation in the first year, and then 70% as years go on until it's totally phased out. Which means that now is really the time to take advantage of this tax benefit. Buy property today. I would say, do it now, because you still have 2 months before the end of the year to get for your 2019 taxes. It's incredible. I will point out one other thing that you kind of hinted on just now that I'll allude to. You alluded to, which is that the tax benefits of this, right? Like you said, they carry over. Meaning, if you have $1 million of depreciation, again, just to repeat, I said at the beginning, it doesn't mean you're like making your property go down in value. Again, this is just a borrowed term. It's a theoretical, it's a borrowed term, means you get this tax deduction. If you have more depreciation, more tax deductions than you have income, even after your income from the properties, even after all of your other income, even after all of your spouse's income, and you guys are set up making lots of money and paying 0 taxes, what happens with that extra depreciation that's left over that you didn't use? It doesn't go away. It actually it's considered a passive loss. Correct. It carries forward. It's put in like an imaginary bank account. And that goes to the next year. And next year, when you have income tax, that can come out, and now you can use that to offset income in future years. If there's anything less until you sell the property, at that point, all of that passive loss from the property gets released. And at that point, there's a hierarchy, which is great. If you have deductions, offsets your income. Like as I said before, if you do an exchange, you don't have to worry about that, right? You're deferring capital gains tax, you're deferring depreciation recapture tax, you're pushing it off. But let's say you have extra depreciation and you have capital gains tax. Let's say you didn't do an exchange. The depreciation can now be used to offset those gains as well. So it's beneficial to take those losses, carry them forward, right? Like you mentioned before, Donald Trump, is he doing cost segregation? How do you think he has billions of dollars in losses, in paper losses? Because he's taking so much depreciation and it's carrying forward.
The other thing is when we say losses, it's not like a loss, like I'm losing money.
Right.
And the reason I say that is because I had a client ask me, well, wouldn't that make it so I don't qualify for a loan?
Oh.
And the reality is that it doesn't, because the lender actually adds back the depreciation
Correct.
when calculating the income to qualify for a loan. So if I take a loss in my business, my real estate business, meaning I don't make money, I don't qualify for a loan. If I take a loss on the depreciation, a paper loss, then it's different, because it's not like, essentially, when people talk about that there's ways to save money on taxes and there's ways to do it legitimately, this is one of the benefits, and this is one of the ways that the IRS actually encourages people to do it. The only problem is that not a lot of people know about this kind of stuff, specifically me. And I've been in the business for 8 years, and I've been selling tons of 400 plus properties, dealt with commercial people, and I didn't find out about it until this year. And now I'm like, oh my God, I couldn't really believe it. Let me ask you, can people only do a cost segregation study when they buy the building, or can they do it years later? And also, can they do it after a major rehab? And how would that work as well, too?
Both excellent questions. So number one, yes, you can do it retroactively. You do not have to do it in the first year of ownership. You can do retroactive. I mean, if you like yourself, that you just found out about this and you own, X amount of, bunch of properties, you can now go back and get those tax benefits retroactively, and doing so without amending any tax returns. Okay. And I want to stress this, because never a good idea to amend your tax returns. It's basically a red light for the IRS to come and audit you. Whereas cost segregation is not any red light whatsoever. Again, we're playing by the rules of the IRS, that are in the Internal Revenue Code. That's what cost segregation is. So doing what we call a look back study, which we're going retroactively, all that needs to be done is filing a form that is an attachment to your tax return. It's called the 3115 form. And all that does is a change of depreciation method. You're basically telling the IRS, I was depreciating it straight line, okay, with a little bit every year. Now I'm doing it in actually the more accurate way, the correct way, because the IRS wants you to take, to identify each individual asset, each property in its proper depreciation life. So doing this retroactively can now get you that 5-year property that we're spreading over 5 years. Let's say you bought a property 5 years ago, okay? You do a cost segregation today, this year you can now get, it's like bonus depreciation in a way, because now you're getting all that 5-year property in this year, in year number one. So you actually can get bonus depreciation in a sense retroactively if you're looking at a property that you purchased in previous tax year.
So the other thing, guys, that I want to encourage everybody to do, if you own any large commercial property, or you own anything that is $1 million plus, what I would encourage you guys to do is talk to your accountant and look at your taxes and see how you've been taking depreciation. For a long time, I took the standard depreciation. I took the 27.5 or 27.5 for residential real estate. What that means is that I took the depreciation over just the standard. And it doesn't make sense to do it that way with bigger properties, because if you think about it, different aspects of the building are going to depreciate faster, and there's going to be some that depreciate slower. So why not be able to take the depreciation that depreciates faster? Why not be able to take that now versus having to wait, if it can help you in terms of taxes? So I would reach out to Yonah. If you, a friend, anybody, I would share this video, friends, family, and just let them know that this does exist, that there are people doing it, and that it may benefit you if done properly. Yonah, what else? Is there anything else that you would like to add, or that you feel that our consumers should know as it relates to cost segregation? Sure,
because you actually asked a second question about the rehab, and what if you're renovating a property? So I do want to touch on that, because that's also a very important aspect. Like I mentioned before, the depreciation starts when you close on the property, right? When you place it in service, it's called. That establishes your depreciable basis, meaning the amount that you can write off over the next 27.5 years. Unless that doesn't change. It doesn't change when you refi a property. Let's say you refi it and you get an appraisal and now it's, $4 million, and now 10 years from now it's worth $10 million. It doesn't change the tax basis. Okay, your tax basis stays the same. The one thing that does change the tax basis is when you add money into the property, when you do renovations. So two things happen when you do renovations. Number one is that, let's say you replace all the kitchens in your property. Okay, you put in $500,000 into replacing all the kitchens. Just an example. There's a lot of stuff. First of all, that entire $500,000 now gets added back to the basis. So your $4 million basis now becomes a $4.5 million basis, meaning now that $500,000 you're going to depreciate as well over 27 and a half years. Unless you allocate on the renovations, you can do an additional cost segregation study on the renovations amount, which generally speaking is a lot more benefits because there's very little structural involved. Okay, roofs are structural, that's 27 and a half year, but appliances and countertops and cabinets and all that stuff, linoleum floor, all that stuff is 5-year property, which means a significant amount of that $500,000 in our example will actually be eligible for cost segregation, meaning it's 5-year property, and you can allocate that to such and takes those tax benefits now and take the bonus depreciation now. So you're, number one, you're writing off. I didn't mention you actually can write off the value of whatever you disposed of. Mm-hmm. Okay, you write that off your taxes, so you're no longer depreciating. You're no longer paying on that which no longer exists, and now you are adding back to the basis more property which you can depreciate.
So I'll give you guys a real life example. Like my family and I own a commercial building and we are renovating it and we're considering putting a laundromat there. Mm-hmm. And I was asking Yonah and I was asking a cost segregation specialist, should I do a cost segregation study once I get done with the rehab of the building and once we get finished with the laundromat? And what is the answer to that, Yonah?
So exactly, if you're putting a large amount back into that property and significant enough, I would say even $100,000, a few $100,000, you can now take that, especially a laundromat when it's a lot of appliances, a lot of equipment. Mm-hmm. Okay, all of the majority of that money being spent on those renovations can now be written off in year number one with bonus depreciation when you spend that. And the amazing thing about this is, which I should have said this at the beginning, this goes again on the amount that's spent, not the amount that you spend out of pocket. Meaning if you get that whole laundromat financed, that renovation financed, it's the bank's money and you get the tax deduction.
Yeah, which is great, great. I believe honestly that this is probably going to be one of the most important shows in the Jose Luiz Morales Show. I really appreciate you coming on the show, Yonah. If you guys have any questions for Yonah, where can they get a hold of you?
You can find me on LinkedIn. I'm very active on LinkedIn, especially in the commercial real estate space. I know it's an underutilized platform, which is exactly why I'm so active there. Reach out to me, or you can email me. I'm sure Jose will put my email, Weiss@MadisonSpecs.com. Reach out. Feel free to, if you do have a property, again, it's worth getting that free estimate to see what the numbers will actually be, and it's actually very educational.
And then just so you know, everybody, I recently used Yonah for a deep cost segregation study that we did, and my experience was nothing but positive. So essentially, the reason I hired him is I talked to a couple of companies, and when I clicked on his Facebook profile, it didn't say anything else. It just said cost segregation specialist. And I was like, all right, I want somebody that specializes in this. I don't want somebody that does it here and there. I want somebody that knows this stuff. So reach out to him and he'd be happy to help. So once again, everybody, thank you so much. We appreciate your time. Yonah, thank you for coming on the show. And I look forward to working together more in the future and continuing to help each other out.
Thank you. I appreciate you having me.